Have you ever wanted to buy a property without having to use the bank? Well, you're just in luck here. This is the video for you. We're gonna be talking all about vendor take-back mortgages, or VTBs. There is a big trend out there online right now, at least in Canada, where if you go and search for vendor take-back mortgages on realtor.ca, you'll see all the different opportunities that are coming up. So watch right to the end of the video so you can get all the juice on this. You want to learn how to do this to be creative here in 2023. Let's jump right in. And for those of you just getting to know me more, I'm Corey McKinnon, multiple 8-figure real estate investor, been investing for close to 2 decades right now. I put together content like this so you can struggle a little bit less buying your first income properties. Don't forget to hit the like button, subscribe to the channel, drop a comment down below. I answer all of them, but let's jump right into the meat and potatoes of this video. So, on to the main topic here, vendor take-back mortgages. I've been privileged enough to receive a bunch of these over the years and also give a few of them as well here too. And I wanted people to really understand this because when you go and do a search for this sort of thing right now, there is literally hundreds of these on realtor.ca, as you can see up on the screen right now. So this is what you need to do to be able to capitalize on these types of things and understand all the different moving parts when it comes to vendor take-back mortgages. So let's jump into all the different terms that you might see in a vendor take-back mortgage. So simply, a vendor take-back mortgage is when the seller will literally give you the mortgage. It could be a first position mortgage, which is the majority of the bank loan or the loan. Sorry, there are no banks involved. They are being the bank. Or it could be a second position loan on the property, which would be a smaller piece of this here, but they're still lending you money on the property. Now, typically these loans are registered on the title of the property. That's how the owner gets security that their money is going to be in good hands, because if you ever default on any of the payments, they can also start the foreclosure process just like the bank could. All right, so let's talk about all the different moving parts when it comes to a vendor take-back mortgage. First of all, you're gonna have the amount that they're willing to lend you, okay? This is typically based on a loan-to-value percentage, and some people might lend you 50% of the mortgage. Some of them might lend you all the way up to 100% of the mortgage, which I wouldn't recommend these days, although us as the investor would love to see a 100% vendor take-back deal come across our desk. I've had them at 65, 70, even 85% in my past history. So that's gonna be the amount of the mortgage. Now, the next moving part is going to be some of the other terms, like what is the interest rate that this loan is gonna be given to you at? And I've gotten them at prime. I've even got a vendor take back at 0% because they were really happy with the purchase price that they got on their property. And they basically threw in a 0% vendor take back for 27% of the overall amount of that purchase property. So it's a pretty cool deal that we were able to do back in the day. So that's gonna be interest rate. And sometimes the interest rate is actually gonna vary depending on what year you are in your term. And that's the next point here, which is the term of the agreement. How long are you actually gonna do this business transaction with each other for? Very common for 1 year, but even all the way up to 5 years with an option to renew. So there's always gonna be extra clauses that you can put into this agreement that you have with the seller. And one of them is gonna be, is there an option to renew? Or here's a real ninja trick for you, is it transferable? Because if it's a good deal for you today, but it might not be a great deal for you halfway through the vendor take-back mortgage terms, you could sell the property to somebody else and the vendor take-back mortgage could be transferable to somebody else. I know I helped a student of mine one time. He found an okay deal. It was kind of like getting to first or second base. But then when he made it transferable, we knew this was gonna become a home run because he was gonna really burr the property and then sell it off to someone else really quickly for a lift and a profit there, all within the first year. So those are some of the important terms here. Other important terms would be, how is the interest paid back, or what do the payments look like? Sometimes it's gonna be interest only, which is gonna be very popular if you're needing to do a lot of renovations on the property. You can tell the seller, hey, I've got to stabilize this property. I'm gonna be dumping a lot of money into the renovations. So can we do interest only payments on this? Let's say, here's an example on a $500,000 property. Let's say if they gave you a loan to value of 50% of the mortgage amount, that would be $250,000 at 8% interest only. That's $20,000 a year. That's all you would need to be paying. Now, usually the owner or the seller is gonna wanna have a little bit more security in the deal. They wanna see that you're actually making more than just interest-only payments. They want some of the principal of that mortgage being paid down as well. So it could be interest plus principal based out on a amortization period of 10, 15, 20, 25, 30 years, okay? You would pick the amortization period, which is the length of time that the entire loan would need to be paid off on. Now, one other term that might be in your vendor take back is it might be on an escalating scale of how it's paid back. They might want chunks of it paid back over time. They might give you a certain interest rate or interest only for the first year of the vendor take back, then it kicks into interest and principal. Then they might want $50,000 paid back in year 3 and also in year 4, and then a balloon payment, which means everything needs to be paid off in the end of the vendor take back mortgage. So a balloon payment is just literally where everything needs to be wiped out and paid back to the owner, essentially wiping out the vendor take back at that point. So you're probably asking yourself, why would a seller want to give me a loan when I can go get one in the bank? Well, lots of sellers these days have to actually be a lot more creative to put deals together. There is so much inventory on the market. The days on market are getting longer and longer now as the market is cooling off and interest rates are going up and home prices are being driven down just because of that monthly payment to own a property is, getting really skewed. So they're gonna basically be doing whatever it takes to make a deal with you. And that's why, whether it's a principal residence or an income property or even land, owners are willing to put vendor takebacks on these types of deals just to make things work. They also might be in a position where they want to defer some of the capital gains, all right? So what that would mean is if they're in a higher tax bracket, like they're making over $100,000 a year right now, even if they're close to retirement, they might be looking at ways to defer their capital gains or the profits on the sale of that property, which up here in Canada, you have to declare them as income. It's not right at your tax rate. So if you made $50,000 worth of profits, the capital gains rate is not that you're going to be declaring another $50,000 on your tax return that year, but it is 50% of the capital gains in most cases. So if they can give you a vendor take back, they actually get to defer that by up to 5 years. All right, I'm not an accountant, but make sure you're getting accounting advice when it comes to all these different things, especially if you're the seller and you want to hold a vendor take back. But that's one of the reasons why they do it. They know that they're maybe 2 years away from retirement, then their income is gonna drop because maybe they're on pension income at that point. So at that point, they can declare the capital gains income and just be in a much lower tax bracket at that point. Another reason that sellers may want to give you a vendor take back is because they really believe in the property and they actually want to keep making some income, all right? So I know when I get to a point where I'm going to be selling off some of my portfolio, I probably won't mind giving some vendor take backs on some of the deals because I want to keep making some income. And guess what? If you miss your payment, then I get to start the foreclosure process and I get my property back, which I already liked anyways, and I did a lot of renovations on, and we picked the tenants anyways, I will be getting that back. Another reason could also be that they're very entrepreneurial and they are literally an investor at their heart, and they don't mind giving you a vendor take back because they're trying to be a deal maker. Maybe somebody gave them a vendor take back in the day, so they don't mind paying it forward to you. So there you go. That's the reasons why a seller might want to do this. Lots of times it's actually a really smart portfolio sell-off plan for them. They kind of sell one property a year, they give a vendor take back, and they also stagger when the vendor take backs will have all those final balloon payments and all those profits coming into their account. So why would a buyer want to get a vendor take back? Well, it's pretty obvious, like somebody is literally wanting to give you a mortgage on their property. And with the banks getting stickier and stickier around their lending qualifications and requirements, and especially with the rates getting higher and higher too, if somebody is literally willing to say, look, I will give you a mortgage on this property if you buy it from me, it's pretty easy to do. But let's really break it down and make sure you know all the benefits, because there's not just one, there's many here. And one of those benefits is actually being able to scale your portfolio a lot faster. If you can pick up a couple vendor take-back mortgages, then you can go from 0 properties up to 3 very quickly. Another good benefit here is it doesn't show up on your credit report, okay? So when you do eventually go to the bank to get a mortgage, this is a little tip, is that your vendor take-back mortgages, even though that owner has registered on the title of the house, the bank would literally need to search the titles of all the properties that you own. It's not going to show up on a credit report from any of the popular credit rating agencies here up in Canada. So those are the reasons why you want to get into vendor take-back mortgages. Hopefully this video helped you a little bit understanding the whole strategy here. Make sure you drop a comment below. Make sure you are absolutely subscribed to the channel. We have a lot more content coming out here all the time. And thank you so much for tuning right into the end here. Let me know if you've ever gotten a vendor take back mortgage. What were the rates? What were the terms that you got? Did you ever get better than a 0% vendor take back mortgage like I did one time? What's the highest that you paid? I'm kind of curious. I answer all the comments. So looking forward to hearing from you. Until next time on the next video, be amazing, my friends. Real estate still works here. You just have to do real estate a little bit different going forward when interest rates are increasing.